Hello student, good evening all of you. Today we will discuss the subject called financial accountancy. Under the subject of financial accountancy, basically today we will discuss on the topic called piecemeal distribution of cash. First of all, let us know what we will cover, what we will cover under the topic called piecemeal distribution of cash. Point number first, we will discuss what is piecemeal distribution of cash. Point number second, which we will be discussing, that is liability settlement. The liability of all the liability holders to be paid in a system called order of payment. After discussing liability of settlement, we will discuss what is mean by proportional payment or pro rata payment. Point number fourth, we will discuss excess capital method. So, begin with the session. Let us begin with the session. Basically, this chapter is directly concerned with the dissolution of partnership form. Student, as you already know, that under the Partnership Act 1932, there is a provision for admission of partner, provision for retirement of partners, provision for dissolution of partners also. So piecemeal distribution of cash, the chapter which we are discussing, it is comes under dissolution of partnership form. Friends, as we all know that dissolution of partnership form is not a one-day process. It takes 3 to 6 months to wind up the partnership form. After the payment of all liabilities by selling all the assets. This chapter deals with how such a process takes place. So, coming to the first point, meaning of piecemeal distribution of cash. So, piecemeal distribution of cash is concerned with systematical distribution of cash at the time of dissolution of partnership firm. While winding up the partnership firm, there is a system we have to follow to pay the cash in that system. Cash which is paid in stages or gradually is called piecemeal. The dissolution of firm is a lengthy process. The assets are realized in stages or gradually. Now, one day we cannot sell all assets, we cannot get all cash, so it is a lengthy process. The liabilities are also paid in stages and or gradual. In short, the money which is realized after selling of assets distributed among liability holder in piecemeal. That means in stages or in a gradual way, but not in a single slot. Single shot you cannot pay because we will not get cash immediately selling of all assets. This is known as piecemeal distribution of cash. Hope you are clear with the meaning of piecemeal distribution of cash. Now, second question arises at dissolution, what will happen exactly with the liability and assets? What will happen exactly with liability and assets of the partnership firm which are being dissolved? Right? Liabilities are settled with the assets sold, right? But the question arises, which liability should be paid first? Without first. So here we will discuss on liability settlement. there is an order of payment to be made at the time of settlement of liability called liability settlement. Student, now if you can see here, in a piecemeal distribution, the amount realized from assets are used to settle the liabilities in the following orders. First of all, we will clear out that there are two types of liabilities under the balance sheet of partnership firm. Point number first is called external liability. You see, this is called external liability. External liabilities are subclassified into three categories called realization expenses, which may be called as dissolution expenses. I'm writing here dissolution expenses. So, before paying any liability holder, creditors, outsider, the firm has to pay the realization expenses at the time of filing of the partnership form. After payment, if there is any unrecorded liability or a liability which may arise after the winding up of the partnership form, after the dissolution of firm, that is called contingent liability, should be known to the partnership firm and some amount of reserve to be kept for that. Some amount to be reserved for the unrecorded and contingent liability. After keeping some amount for contingent liability or unrecorded liability, we have to pay outside liability called as external. Basically, it is the first external liability to be paid at the time of dissolution of partnership firm. So the chapter piecemeal distribution is basically talk on these type of liabilities to be paid and the order of payment made. Outside liabilities are again subclassified into two categories. One, secured liabilities. Secured liabilities are nothing but firm may placed any asset, may mortgage any asset of the firm are hypothecated by any asset by firm to take that loan or liability. To take the debt, that is called secured liability. It should be paid first before the payment of unsecured liability. Unsecured liability are again unsecured liability are opposite of secured liability. There is no any pledge, mortgage or hypothecation of any asset by the firm. But the condition is that unsecured liabilities are again subclassified into two parts called as preferential liabilities and other than preferential liability unsecured other. What are preferential liabilities? These are the liabilities which are like government dues to be paid, like income tax, municipal taxes, taxes which is collected by government. The partnership firm must have to pay before to pay unsecured liability. Employees dues like salary of staff, any compensation for the termination of services are the example of preferential liability of employees dues. After the payment of preferential liability, firm can pay other unsecured liability like creditors, bills payable, outstanding expenses, bank overdraft, etc. After full payment of external liability, you see after full payment of external liability, firm has to pay internal liabilities. So at the time of dissolution of firm, we have total five liabilities. One, two, three. Three are external, two are internal. Is it clear? So internal liabilities are Two types. One is a partner's loan and second is a partner's capital. Before paying to the partner's capital, firm has to pay partner's loan. After the payment of partner's loan, the firm at the last stage have to pay the partner's capital. Partner's capital is to be paid. First, partner's surplus amount of capital to be paid if arising as per the statement of excess capital method. We will discuss about what is excess capital method. Later, we will discuss on this topic. So after payment of surplus, whatever amount is kept, it will be paid to all partners into their profit sharing. Now, hope student you are clear with two types of liabilities, external liabilities and internal liabilities. External liabilities are classified into three categories. One, realization expenses. Second, reserve for unrecorded or contingent liabilities. Third, outside liabilities. And outside liabilities may be secured or may be unsecured. So unsecured liabilities are paid first, unsecured liabilities are paid later. There is a provision in Partnership Act 1932 that at the time of dissolution, the order of payment should be followed in this manner. Coming to the next point, key, if suppose a firm at the time of dissolution, some amount of cash received after selling of asset, which is called realization amount, which is called realization amount. If the cash is not sufficient to pay any liability, then what will happen? Then whom to pay first? Taking examples, say what is cash is not sufficient means the cash is not sufficient. Like we have outsiders like creditors, bill payable. Their outstanding balance is 20,000 and 30,000. That is 50,000 total. But we have only cash that is a 40,000. So we are short of 10,000 in cash. So what will happen? Whom to pay first and how much to be paid to them? In that case, there is a provision if the cash is insufficient to pay all dues, the payment is made to the concerned creditors in proportionate. That is called proportionate in the ratio of their outstanding balance. Let us take example how we are doing calculated. We will take the example later on how we decide about the ratio of outstanding balance. Similar way, partners loan after the payment of external liability, partners loan, which is the internal liability we have to pay before to pay the partners capital. So after payment of outside liability are paid, the internal liability partners loan are paid in the next stage. In the same situation, if the cash is insufficient, the payment is made against all partners loan proportionally in the ratio of outstanding balance similar to the outside liability. In all cases, whenever the firm is paying any liability, if the cash is insufficient, then the liability which a firm is going to pay, that will be paid in the ratio of outstanding balance. Liability may be of any external, internal, any of. So that is called pro rata or proportionate payment. The liability which is paid in outstanding as per the outstanding balance is called proportionate or pro rata payment. Partners' capital are also paid in a pro rata if the cash is not sufficient. After full payment of all outstanding liability as well as partners' loan liability, the partners' capital are paid off in the last. As we have discussed earlier, that at the last, the partners' capital to be paid. So if the cash is sufficient, the all capital to be paid off. But if the cash balance is insufficient, then payment must be made between all capital accounts proportional. The capital balance are in the profit sharing ratio, then there is no problem at all. The payment is made to the all partners in the ratio of their capital balance. If the profit sharing ratio is equal to the capital balance of partners. But if the capital is not in profit sharing ratio, student, in that case, the payment at each state must be done after calculating excess capital of partner and keeping the capital balance of partner in their profit sharing ratio. This is the most important point, that partners' capital to be paid in the manner called as excess capital method. First amount to be paid the excess capital of partner. Later, the amount to be paid as per the proportionate capital, which is capped as per the excess capital method. Why we are doing this so? The reason for the payment in such a way is to ensure that the ultimate profit or loss on the realization is distributed among partners in their profit sharing ratio. Their profit sharing ratio. Is it clear, student? So, moving towards method, that is excess capital method, is in four names. We can call the four names for excess capital method. One name is called proportionate capital method. You can see the name, proportionate capital method. This method is also known as surplus capital method, highest relative capital method, excess capital method, or quotient method. Basically, we are talking about excess capital, that is simply called as proportionate capital. What what is going on under this proportionate capital? How we will calculate proportionate capital practically? We will discuss on. We will discuss further. Under this method, for first the capital are compared with the profit sharing ratio. First of all, the first step we have to do, that we should check the partner's capital, whether their capital is as per the profit sharing ratio which they are getting or not. If this is not, then there will be the excess capital. So we have to calculate excess capital, the actual capital less capital proportionate to profit sharing ratio is called excess capital. So here is a format, we will discuss on that. After excess capital are paid, all capital are paid in the profit sharing ratio. Then the payment can be made in the profit sharing ratio. Thus, now take an example. You can understand very easily after taking example. Suppose A and B are share profit and loss in the ratio of 2:1. There are two partners called A and B. They are sharing profit and loss, that is 2:1. And A's capital is 25,000, B's capital is 5,000. Now, student, can you imagine, can you say that the capital of A, that is 25,000, capital of B is 5,000, there is a big difference between that capital? Yes, definitely their capital is having a showing big difference. If we see their profit sharing ratio, that is 2:1, their capital is not in that manner. Their capital is exactly, if you see, B's capital is 5,000, and if I multiply 5,000 to 5 times, it is 5 5s are 25. 25,000 means A's capital is 5 times as compared to B's capital. But the profit which A is getting, that is only 2 times if we see the 2:1. So the capital are obviously not proportionate. Capitals are obviously not proportionate. If If B contribute 5,000 for one third shares, then A should contribute 10,000 for two third shares. We look into that. Thus, the A's capital is excess. How much it is excess? The total capital contributed by A is 25,000. As per our assumption that A should invest only 10,000. So if we deduct 10,000 from actual capital, we will get 15,000, that is excess capital. So this is the method we have to calculate first excess capital by comparing capital as per the profit sharing ratio partners are getting. That's why the method is called proportionate capital method. Under the proportionate capital method, first A will be paid 15,000 to bring down his capital to the 10,000, which is now can be proportionate capital. Now both the capitals are paid in the profit sharing ratio. The subsequent payment will then be made in the profit sharing ratio. Hope you understand what is excess capital, what is proportionate capital, the same name. So basically, this is to be done to understand that the partners who has invested more amount should pay first. More amount is the amount he or she has invested more than it's he or she is getting profit. That is a more amount we are talking in a simple term. Now for calculating excess capital, we have a format. We will discuss on that also. Format of excess capital method we will discuss here right now. Now see format of excess capital method. Okay, this is a basic format to know whose capital is excess in the partnership form before the dissolution of partnership form. So what we have to do, we have to make the columns as per the partners. If there are three partners, then we have to make six columns. See, three columns to be made for the details and other columns depending upon the partners. If the partners are three, then six column, partners are four, then seven column, partners are seven, then seven plus three, 10 columns. Basically, the format is that. Now, what we have to do? We have exactly we have six steps, which are which can be understood by a student. And after six steps, if you see, means 7, 8, 9, 10, 11, these are repeating again. Okay, these are repeating again. If you see that step number 1 is called profit sharing ratio, and if you see at the step number 7, that is again the profit sharing ratio. Then it is profit sharing ratio. So step 6 is basically you can understand. So these step 6 can say that excess capital of one partner. If the partners are more, then these steps will increase. So if there are three partners, we have to calculate 2 time excess capital. 1 time excess capital, one partner removing other two partners, and then second time again we have to calculate, that is on 11 steps, that is called final excess capital. It's supposed to say if there is one more partner, that is fourth one D, then we have to repeat the same 4 or 5 steps after 6 steps, then to calculate again the excess capital. So let us look at this. First, we have to write profit sharing ratio, which is given in the question. Second, we have to write it adjusted capital of partners. That is adjusted capital. Capital plus if there is reserve, which is given in the question. Other than reserve, sometimes uh, loss on the profit and loss account is also given on the debit side of assets. That will be deducted to arrive at adjusted capital. So the reserves are given to the all partners as per their profit sharing ratio. I have used some short form for you so that you can understand well. Then we have a step 3 that is called unit capital. Unit capital is nothing but 2 divided by 1. 2 is your adjusted capital. If we are dividing adjusted capital by profit sharing ratio, we will get unit capital. Okay. So here one column we call it formula column. We have written the basic details formula, how we calculate the each steps. The 3 columns are partners in particular and steps columns are there. Step 4 we have to do base capital. Base capital. Base capital is nothing but comparing the unit capital whose lowest is called base capital. I have taken here example that B's capital is lowest. So I have written here lowest of unit capital example partner B. Just giving the example that any of partner may be lowest amount, we will have to write base capital. Base capital is nothing but lowest amount. We will take the time of comparison of capital. Then after calculating base capital, we'll go with the proportionate capital. Proportional capital is nothing but multiplying base capital into profit sharing ratio. Base capital is supposed to say here 10,000, then 10,000 multiplied by profit sharing ratio of each partner. Supposed to say A's partners profit sharing ratio is 3, then 3 multiplied by 10,000. 2, 2 multiplied by 10,000. 1, 1 multiplied by 10,000. So the proportional capital. Why we are doing this so? We are doing this so to come out at the proportionate capital of partners. So after calculating proportionate capital, we'll have to come at excess capital. Excess capital is nothing but difference between adjusted capital minus proportionate capital, like 2 minus 5. 2 minus 5 is second step minus fifth step. Just to minus that, whatever comes is called excess capital. So basically I have written for B is a nil. Why I have written a B nil? Whose lowest capital comes, their capital will be nil. Definitely it happens with the partners. So lowest capital, excess capital will be nil because its capital is lowest. So how can we can say it's a excess capital in the business? So repeating the same steps again to write profit sharing ratio, but now write profit sharing ratio of partner which are balanced. Other than B, here we have written profit sharing ratio of A and C. Why we have written A and C? Because B is having a lowest capital. So A and C we are writing here their profit sharing ratio which is given in the question earlier. Suppose here it is given 3, then you write it here we also 3. It is here given 1, you just write it as 1. Proportionate excess profit sharing ratio. After profit sharing ratio, the step 3 which is there, this is being repeated. Unit capital, here we have written new unit capital. So we are comparing 6 divided by 7, you will get the new unit capital. 6 divided by 7. What is 6? 6 is excess capital, 7 is proportionate capital, profit sharing ratio. So just to divide it, whatever comes is called new unit capital. Again, you have to repeat base capital. Here we have written base capital, write down here new base capital. New base capital. So now there are two partners. B is already lowest capital. A and C, whose capital is lowest, called as base capital. So I have taken here C is the lowest. Supposed to say I'm taking a C. C ka lowest है, so we'll take it that. So those capital is lowest, but you don't write it here. Only write it lowest amount here. For the purpose of comparison, we will take that. Then after taking the lowest capital, again to calculate the proportionate capital. Like a proportionate capital, calculate the mean proportion. Similar to 9 multiplied by 7. Over here, what we have done, 4 multiplied by 1, here 9 multiplied by 7. 9 step multiplied by 7 step. 9 is base capital multiplied by proportionate ratio. We'll get the proportionate, new proportionate capital. After new proportionate capital, you will get the final excess capital. One time we have written excess capital, now we write final excess capital. So these steps going on with the partners increase. If the partners D comes, then we have to repeat the last four steps again from 7 to 11, 7, 8, 9, 10, 11. 5 steps. We are talking about 5 steps to be repeated. The partner increase. So here at the end, if the lowest capital of C is we have taken, so A's capital will be X's capital. Definitely you should know who are it, who are the partners was taking lowest. Lowest we have taken first in case of B and second case we have taken C. So definitely A is having highest capital called X's capital. So student, I think hope you are getting the point what I'm trying to convey you the message. Now take a example, practical example, how excess capital has been calculated. Now format we have discussed. Hope you are getting the format. This is a common format we have to follow to calculate the excess capital before the payment of all liabilities. In case of dissolution of firm, if we are discussing about dissolution of firm, we have to calculate the excess capital before the payment of partner's capital and outside liability. So take an example here. Illustration 1 excess capital method. Question 1. A, B, C are partners profits sharing profit and loss in the ratio of 3 is to 2 is to 1. Their balance sheet is as follows. Here A's capital is given 30,000, B's capital is given 30,000 and C's capital is given 20,000. And reserves are also given in the question with the fixed assets and current assets amount is given. What is asked? Calculate surplus capital of partners from the above information. This is actually not a question. This is a calculation which I have made. Now, what is surplus capital? It is nothing but excess capital. I already discussed that excess capital method is having four names: surplus capital, highest relative capital, quotient method, and proportionate capital. They are exactly asking to calculate the excess capital. So now let us see as per the format what I have written here. Take it here. Profit sharing ratio I have written on the step 1. 3 is to 2 is to 1, which is given in the question. Check it here. 3 is to 2 is to 1. Okay. This is we have to basically write down only as per the given. Then we have to calculate as adjusted capital. Write down the capital of partners. I have written 30,000, 30,000, 20,000. Okay. So this is in the question. And then what I have done now, I have added the reserves and surplus. Reserve surplus total amount is 25,000, which is given in the question. So we have to distribute this 24,000 amount among the partners in their profit sharing ratio. I'm calculating here how to do this calculation for your reference. So let us see 24,000 multiplied by first partners ratio is 3. So 3 divided by 6. You will get 12,000. Okay. So in case of this is the A's share in the reserve. A's share in the similar way you can calculate B's share. What is the ratio? Amount will be the same. If their ratio is changed, here the ratio is 2 is to 6. It is 8,000. Okay. And C's capital ratio is 1. So 1 is to 6. That is 4,000. I'm taking it 6. How? Why I'm taking it 6? You have to total the ratio which is given 3 plus 2 plus 1. This is a basic calculation of calculating ratio and amount. Okay. So student, I think you understand this 12,000, 8,000, 4,000 which we have taken here, how it comes 12,000, 8,000 and 4,000. After adding this result, we will get the adjusted capital, that is 42,000 of A, 38,000 of B and 24,000 of C. After this we have to do unit capital. Unit capital is nothing but 2 divided by 1. We have discussed in the format. So adjusted capital divided by profit sharing ratio. Here adjusted capital is 42,000 divided by 3. We get the 14,000. Similar way here, capital of B is 38,000 divided by 2 will be 19,000. After calculating A's 24,000 divided by 1, which is similar to 24,000. Now after calculating unit capital, we have to decide whose partner's capital is lowest. So if you see that 14,000 is lower amount than B and C. Okay. So in this case, the A's capital is lowest. So what I have written here, the partners A is 14,000 lowest capital. We don't write it here. We just have to decide about whose capital is lowest as per the capital which is considered as lowest. So after calculating 14,000, just to multiply 14,000 by 3, multiply 14,000 with multiply 2, and then 1. In case of A, multiply 3, in case of B, multiply 2, and in case of A, multiply. You will get this amount similar to 42,000, 28,000, 14,000. This is multiplication of PSR with base capital. PSR is nothing but profit sharing ratio. Then we have to calculate excess capital. If we see that A's capital is lowest, so if you see the excess capital formula is 2 minus 5. 2 is your adjusted capital, that is 42,000, and 5 is again comes 42,000. 42,000 minus 42,000 becomes nil. Definitely in all questions it comes nil. If you calculate each and every question, it comes nil because of the lowest capital. It normalize the capital of such a partner in the business. So here 38,000 minus 28,000, you will get 10,000. In the case of C, 24,000 minus 14,000, you will get 10. In case of B and C, their capital are 10,000, 10,000. Still, we have to do repeat the process to know from B and C whose capital is high. You can say, sir, here is a 10,000, here is 10,000, then there will be no excess capital. But I can say no, there is excess capital, though their capital excess capital is showing right now 10,000. But if you can see their profit sharing ratio is different. Here 2002, and in case of B, the profit sharing ratio is 2, and in case of A, profit sharing ratio is 8. So it is showing that there is a difference in capital of B and C also. So that's why we have to repeat the again steps. Profit sharing ratio of B and C is 2:1, which is given in first step. Again calculate unit capital. 6 divided by 7. Here we have 2 divided by 1. Now we have to divide 6 divided by 7. So you will get 10,000 divided by 2. You will get the 5,000. 10,000 divided by 1. You will get. Now after this, think about the lowest capital. Who's lowest? Check the unit capital 5,000 and 10,000. 5,000 is lowest. So B's capital is lowest. Okay, comparing with B, base capital, we'll come to the lowest. After new base capital, we'll come to the new proportionate capital, similar to multiplying the base capital with the PSR, profit sharing ratio. So 2 multiplied by 5,000 is 10,000. 1 multiplied by 5,000 is 5,000. 1 multiplied by not 10,000, 1 multiplied by this base capital. We have to multiply base capital to come out to arrive at proportionate capital. So now if you see that new proportionate capital is 10,000 and 5,000. So definitely final excess capital if we go. So here we have taken B's lowest as per the question. So definitely B will move out, and last C's capital will be excess. The final excess capital comes 6 minus 10. 6 step we have calculated excess capital 10,000 minus 5,000. We'll get the 5,000. Here 10,000 minus 10,000. In case of B, 10,000 minus 10,000 mean. So now after doing this lowest capital comparison, you can conclude whose capital is excess. From here you can conclude. In first time, in the first case, A's capital is lowest. In second case, B's capital is lowest. Definitely the C's capital is excess. From there also we can conclude. But for the sake of calculating or knowing the amount, we should do the step of formula that deducting the bill. Student, hope you are getting this question which is given in the problem. We have calculated that C's capital is excess capital. So after our payment of outside liability, whenever we come to pay the partner's capital, that time first we have to pay the C's capital, that is 5,000. After payment to C, we have to pay B and C 10,000 and 5,000. After payment of 10,000 and 5,000 B and C, lastly we have to pay three of the partners in their profit sharing ratio, that is amount 42,000, 28,000, 14,000. This manner we have to pay is called order of payment. Not only order of payment is applicable to partners, but while paying outside liability, we have to think about the payment as per the order. Student, hope you are getting my point, what I am discussing. So, student, today's session we have concluded. Before concluding the session, I want to overview what we have discussed today. So today we discussed with point number one. If we see point number one, we have discussed, that is piecemeal distribution, meaning of piecemeal distribution. Second, we understood the liability settlement. So we came to know about there are two types of liabilities called external liabilities and internal liabilities. External liabilities are to be paid first, then to internal liability. So some classification we have learned in this lecture. That is called liability settlement order of payment. After the order of liability settlement, we have discussed about the pro rata pro rata payment, that is called proportionate payment. In case of insufficient cash, the firm has to pay the all liability holders in their proportionate outstanding balance. After going through that, we did what is the meaning of excess capital. Then we have discussed about the format of excess capital. Okay, proportionate capital, how calculated proportionate capital. We have discussed with the example also, A and B partners. Format we have discussed, and even practical problem we made on the excess capital. For even you can understand how the excess capital of C arise after following the format. Student, hope you understand the concept. Hope you understand the entire concept in this session. Thank you. We will continue next part of piecemeal distribution in next lecture. That is statement of distribution of cash. How to be paid all of the liability holders. That is called statement of piecemeal distribution. Till now, we have to revise excess capital method under